Today, let's look at the topic of indirect taxation. Now, the first thing to understand is that indirect taxes are often levied in order to solve market failures or to raise government revenue. For instance, we could consider smoking or pollution arising from production processes from firms to lead to market failure, right? Because of the negative externalities that they create. Now, in that case, governments may choose to levy indirect taxes to try and solve that market failure, okay? That's the main reason. Now, another reason could be to simply raise government revenue, okay? Then, the important thing to understand is that there is a difference between an indirect tax and a direct tax. An indirect tax is a tax charge on producers of goods and services that increase cost of production, but that firms can transfer to consumers via higher prices. Okay, that's the important part. On the other hand, a direct tax is simply a tax on the income or profits of the person who pays it. In other words, that's a tax that you cannot transfer to consumers, okay? Now let's look at different types of indirect taxes. Now we have a specific tax and we have an ad valorem tax. Now let's look at what they look like on the graph. Of course, because this is microeconomics, we start with the price on the y-axis and the quantity on the x-axis. And we start with our simple supply curve as well. Now, a specific tax would shift the supply curve this way. S1 plus tax. Now, as you can see, these two lines are parallel, which means that they will never touch each other, okay, if they keep going on indefinitely. Now, what does this mean in terms of the tax? This means that no matter the price of the good, the amount that is taxed is the same, okay, whether it's a high price or a low price, okay? The tax never changes. It's a tax per unit, okay? On the other hand, we have something called an ad valorem tax, which can be represented as this. Now, as you can see, this second curve here is tilted, right? These are not parallel lines because, as you can see, if they keep going, eventually they would touch each other. Now, what this means is that, as you can see, the tax increases depending on the price, right? So, if we join these lines, you can see that an increase in the price when the price is relatively low around here, you can see that the tax isn't that big, whereas when prices are higher, the tax is much greater, okay? Whereas if we do this for the specific tax, we can see that the amount of the tax will be roughly the same, okay? Perfect. And so yeah, an ad valorem tax is a tax as a percentage of the price, okay? So let's say a good example of this is VAT, right? VAT, which could be 20%, right? So yeah, perfect. Now let's look at the impact of an indirect tax on the graph in more detail, okay? So as always, we start with our supply and demand at equilibrium, D1, S1, right? And then let's say the government levies an indirect tax, okay, for this market. Now we can either shed the supply following a specific tax or an ad valorem tax, okay? The impact is the same. So let's do a specific tax this way. So we can label this supply curve as S1 plus tax, right? So this shows that the shift in supply is simply due to the tax, okay? And let's join these dotted lines. So we start at equilibrium, PE, QE, and then it shifts to Q1, P1, for example, okay? So let's look at the impact on these specific things. So firstly, the supply curve. How does this indirect tax affect the supply curve? So as we can see, the supply shifts left or upwards, right? We could say either, means the same. So the supply curve, we could say, goes from S1 to S1 plus tax, okay? So we can say it shifts left or upwards. Very good. Then what happens to the price and quantity? So as we can see, the price rises. So price rises from PE to P1, and quantity decreases from QE to Q1. Okay, perfect. Now, what about the government revenue, right? Because remember, this is an indirect tax levied by the government. So the government will get some sort of revenue from this, okay? Now, in order to show this on the graph, first of all, let's remind ourselves again that this vertical distance here between the curves is the tax, right? Therefore, in order to calculate any revenue, not just government, remember, any revenue is price times quantity, okay? Or in other words, the amount of money you get per unit times the amount of units that you sell, right? So let's see. Let's put some letters here, A, B, C, and let's put D as well here, okay? So in order to calculate government revenue, first of all, we need to take the vertical distance representing the tax. So as you can see, any distance here between this represents the tax. So therefore, we can join this dotted line here up to D. We can call this E. And so we can see, right, that the tax the government gets here is the vertical distance B to D. Okay? And then, if we want to calculate the revenue, we do this amount, okay, which is what they get per unit, times the amount of quantity of goods that they sell, right? Or not sell, but, from the quantity that the firm sells, which would be 0 to Q1, okay? So the government revenue would be B to D, the tax, times the quantity of goods, which is EP1, okay? BD EP1, okay? And I'll just show you this to make it even clearer. This is the government revenue, okay? So the amount of the tax, this vertical distance between the curves, times the quantity of goods, okay? That gives you the area for this rectangle. Perfect. And then we have consumer burden and producer burden, okay? So what do we mean by burden? What we mean by burden is, remember from the definition, here it says that an indirect tax can be transferred to consumers via higher prices, okay? So part of it, okay? So the consumer burden will be the amount of the tax that is passed on to consumers, and the producer burden will be the amount of the tax that is passed on to producers, okay? So the consumer burden then will be the difference, okay, from the price they used to pay to the price that they pay now because of the tax, right? So in this box here, that would be the difference between PE, right, the price they used to pay, and P1, the price that they now pay, okay? So we can say that the consumer burden is P1 PE, and again, times the quantity, right? So P1 PE CB. Okay, now let me show you this as well so it's clearer. this would be the consumer burden, okay? This upper part of the box. And then the producer burden is simply whatever is left from this box, okay? So the rest. So PE, DC, okay? That would be the producer burden, which I'll shade in a different color here, okay? And just to make this clear, I'll put the colors next to it so there is no confusion. And then black. Okay, and then let's look at the producer revenue, okay? So the producer revenue used to be, right, the price that they used to sell goods at times the quantity, okay? Again, so the producer revenue used to be this big box, right? So we had PE, A, QE, O, right? That used to be the producer revenue, okay? But as you can see, because of the tax, right, now producers only get E, right? They only get E. Therefore, the area representing producer revenue would be E, D, Q1, O, okay? So it used to be this big box, but now, as you can see, because part of the tax is passed on to consumers and part of the tax is passed on to firms, so to producers, this means that the producers still have to take on some of the tax, which means that the price they will get, the money they will get, will be lower, okay? And so that's why the producer revenue decreases to this box here, okay? And finally, let's finish with deadweight loss. So the deadweight loss is the welfare to society, okay? And the deadweight loss is this triangle here, okay? ABD, okay? ABD. Now, let me shade it as well so it's clear. It's this triangle here, okay? Now, not to go into too much detail because this deserves a video on its own, but an intuitive way to understand this is that because deadweight loss is loss of welfare, right, to society, it is clear that a tax will cause, right, a loss of welfare. Now, first of all, consumers have to pay more for the goods they get, or for the goods they want to buy, which isn't good for them, right? So that's a loss of welfare for consumers. And as we've seen, producers, instead of getting PE for the goods they sell, they now get only E, okay? So as you can see, this is also a loss of welfare on the part of producers, right? Therefore, this is an intuitive way to understand why there is this triangle of deadweight loss, okay? Both consumers and producers are worse off. The only ones that we could say are better off is the government, right? Because they get some revenue and that is good for them. Perfect. I hope that makes it a bit clearer how indirect tax graph works. If you have any questions, please let me know down in the comments. And otherwise, thank you.